Good morning. Thank you very much, Jeff. When Greg and Rick asked me to sponsor one of the events here, I said, sure. And then they said, okay, great, you're on Sunday at 7 a.m. And I said, I should have clarified that first. But thank you all very much for coming. I really appreciate it. So I'm going to start with a few questions, and just to see and test how awake everybody is. This is a graph of U.S. healthcare spending. We're going to backtrack from malpractice insurance for just a second. Does anybody know how much we spent as a country as a percentage of GDP in 1960 on healthcare? 6%. Wow. He's seen the lecture. I don't know. Exactly. Do you know what that translates to in dollars? It was $49 billion. One interesting thing about this graph is there's a dip. There's only one dip. It's very sharp there. 1983 is your hint. What was that? Pardon me?
Jimmy Carter.
Jimmy Carter? No? Anybody remember that? That was the advent of the DRG. So we resumed the exact same slope in healthcare spending until about the mid-90s. And we had a period of time in U.S. history where we spent approximately the same on a percentage basis for a number of years. Does anybody know or can hazard a guess as to what caused that flat part of the slope? You got to give me a guess. No, the dot-com bubble and bust was 2000 and after. Managed care. Right on the button. So that was managed care, HMOs. And how did they do that? They did that by managing care, denying care. But they were vilified. You remember those press reports. They denied, little Janie her brain transplant and all those esoteric treatments that sometimes did or did not work, but they were vilified. And they figured out that why should we take this hit? Why should we be ranked below tobacco companies, below alcohol companies? Let's just give the American people what they want in healthcare, i.e. everything, and then charge them for it. So if healthcare costs went up 7%, they raised premiums 9%. If healthcare costs went up 11%, they raised them 13%. And so we resumed this upward slope. And in 2005, last year that we have complete data, what did we spend as a country as a percentage of GDP on healthcare? Pardon me? 28? No. That's a little high. 17 is correct. $1.9 trillion. Estimates are now close to 20 or just over 20. 1 in every $5 American people spend is going to health care. Now, who in this room believes that trend is going to reverse or flatten? It's not happening. There's a hand, a brave soul out there. It's not going to happen. It's going to continue to go up. So, with Obamacare, yeah, you may have heard that we've just passed this health care legislation. Over 2,000 pages. How many pages on tort reform? Zero. So what's going to happen in the absence of any tort reform, changes in the tort policies? Nothing. So from a malpractice point of view, nothing changes with Obamacare. Okay? So why did we form longevity? We formed LPI because traditional medical malpractice insurance companies do not understand age management medicine. How many people have called for a quote and told them what they did and got somebody that understood what they were talking about? No hands. When I came to age management medicine and I was doing it full time and called for malpractice insurance, And they said, well, okay, walk us through what you're going to do. And I said, well, I'll see 1 or 2 patients a day, told them what we did. Okay, we'll give you the family practice rate. You know, we're not seeing 20, 30 patients or more per day. We're not doing procedures. We don't have hospital privileges. I just could not understand how my risk could equal the risk of a family practice or an internal medicine or a general practitioner. And yet I was paying the same rate. So I started doing a little digging. I was at the Boca Raton Age Management Medicine Group conference in April, and that's where I started. I just started talking to other physicians. Other age management medicine physicians said, what do you pay? All over the country, I was getting the same ranges. It was these family practice, internal medicine rates. And so I did a little bit more digging. What's the typical loss ratio for those specialties? It's 60 to 70%. For every dollar that a medical malpractice insurance company takes in, they can expect to pay 60 to 70 cents out. Now, that's not all in claims. That's their G&A, that's their advertising, that's hiring lawyers to defend, et cetera, et cetera. So that's what you're paying for when you buy malpractice insurance. So I said, well, what's the loss ratio for AMM, age management medicine? We started doing actuarial studies. We went to a couple medical malpractice insurance companies. We gave them actual claims data from other groups around the country. The risk was much lower than the 60 to 70%. From an actuarial and insurance standpoint, they wanted to build in some uncertainty. So they're saying 20 to 25%, and if that's the case, I believe it's lower than that. You're paying twice as much. The risk is less than half, so your premiums should be less than half. So we formed this company to capture that pricing disparity in the marketplace, okay? To say, let's pass along these savings to age management medicine physicians. And maybe not all in year one. Our actuaries want to see actual claims, actual experience. But over the next 3 to 5 years, we believe we can reduce your premiums if you're a full-time age management medicine physician by 50%. 50% of what you're currently paying. One of the reasons we can do that is AMMG certification. Certification in your field of study lowers your risk. It lowers the insurance company's risk. You have an essential fund of knowledge. Okay? It establishes that higher evidence-based medical knowledge. It increases the standard of patient care. And it's peer-reviewed. You get CME credits for it. So we will offer you an additional 5% discount for becoming certified in age management medicine through AMMG. And you can go to their website, get that, and it's in your written materials as well. So we formed LPI as a captive. There's lots of different types of insurance companies, and now we're going to get into a little bit of the technicalities. But a captive is a wholly owned entity established to function as an insurance company to insure the risks of its parent. That's very simple. It's an efficient loss funding vehicle for risks identified, but where traditional insurance markets are either unwilling or unable to insure the risk at a reasonable premium. And I think that's the key. And maybe even in this case, traditional medical malpractice insurance companies aren't necessarily unwilling or unable. They just don't understand it. So they haven't put the time and the energy into doing the actuarial studies, the underwriting studies. It's a small, and they consider it a niche portion of medicine. And so that takes time, energy, resources to find that out. And there's no one out there doing that. So, and we, as age management medicine physicians, continue to pay the premium. So why should they do that? You're paying to spread the risks of all the other internist family practice, etc. Captives are a very well-known part of the insurance market. Today they represent over $38 billion annually in the United States. There's more than 5,000 captives in a variety of domiciles, both inside and outside of the United States. We chose Delaware for a lot of reasons. There are 35 states that now have domicile statutes. But in reality, there's really only 5 to 7 that really purport to do this and have a lot of captives domiciled in that state.